We have an exciting development to share with you. The Economics and Country Risk podcast and the Maritime and Trade Talk podcast are joining forces to bring you a brand new show, the Decisive podcast. Join our team of seasoned analysts as they explore the ever changing landscape of economics, country risk, maritime trade, and supply chain. Each episode of the Decisive podcast features insights and intelligence that will empower you to make decisions with confidence. Whether you're a business leader, investor, or simply curious about the forces shaping our world, the Decisive Podcast is here to provide you with the knowledge you need to stay ahead. The Decisive Podcast will launch on this feed in June, so if you're already subscribed, you're all set. If you're not, subscribe now so you don't miss our premiere episode of The Decisive, your go-to resource for expert insights and analysis. And now for your episode of Economics and Country Risk.
You're listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
In a previous episode on monetary policy pivots, our economists went beyond the questions of when and how much to the implications of these pivots for businesses. In this episode, we delve further into the different narratives presented by central banks that are raising rates instead of cutting or looking to cut them, particularly in Turkey, Russia, and Japan. I'm Kristen Hallam, your host for today's episode. Joining me for this discussion are Harumi Taguchi, Principal Economist, Asia Pacific Economics, and Shuchita Shukla, Senior Economist, European Economics. Let's dive in. We want to talk about some different narratives now. So the emerging markets are a different scenario, a different narrative from the US and from developed Europe. Let's focus now on the two major outliers in your region, where rates are instead going up. Starting with Turkey, is the defensive monetary policy stance there working as intended?
Yes, that's definitely the one to watch in our region. The turnaround in Turkish monetary policy came in May of 2023 when President Erdogan brought in a new investor respected technocrat as the finance minister and appointed a new central bank governor from the Western banking world. Under this new leadership, the TCMB was allowed to embark on a hawkish monetary policy cycle in order to curb runaway inflation. And the policy rate has been lifted from 8% to the current 50%, 50. But in April this year, the TCMB actually signaled a pause in its hiking cycle as it expects inflation to have peaked in the second quarter of the year. We think that the rates will remain on hold until the end of this year, by when inflation is projected to slip below the current policy rate. Now, in terms of the impact of tightening so far, the current account balance has narrowed even beyond energy and gold trade. And on net, portfolio capital is now flowing into Turkey. But as is the case with most policy normalizations, there are certain necessary adjustments that tend to push in the opposite direction, at least temporarily. And for the TCMB, it has actually had to normalize its exchange rate policies by phasing out administrative restrictions on FX holdings and transactions. And with that dismantling support, the lira has continued to depreciate faster than most emerging market currencies, which means that the foreign exchange reserves are still under 3 months of import coverage. Additionally, the tightening so far has not been sufficient to rebuild long-term investor interest, as despite improving sovereign assessments for Turkey, we haven't really seen any meaningful return of foreign direct investments into the country. So the message really is that although latest adjustments have definitely been welcome, Turkey's long-standing fundamental constraints haven't really gone away. And the primary of those is continued political influence on monetary policy, which means that any shift to greater stability is heavily dependent on continued support from President Erdogan. So the risk of a premature pivot to easing remains quite significant should he deem higher rates to be unnecessary yet again. And that could happen if capital inflows pick up sufficiently or if domestic demand contract too much. So that big caveat notwithstanding, an increasing reliance on short-term swaps to maintain the FX buffers, or an excessive slide of the lira could turn up the TCMB's hawkishness in the next 12 months. But we think that a pause is more likely.
Let's turn to the other outlier in your region, which is Russia, where the central bank has had to hike rates to defend the ruble. What impact has that had, and where do we go from here?
Yes, the other interesting one. So the CBR pivoted to monetary tightening in July last year in order to curb inflationary pressures, but also to support the beleaguered ruble. And of course, a weak currency aggravates imported inflation when domestic demand is resilient. And that's exactly what we've seen in Russia, where state subsidized corporate loans, pre electoral fiscal expansion, and the tightening of labor markets owing to the outflow of skilled labor since the beginning of war, all added to the release of pent up demand. In August of 2023, the ruble crossed the psychologically relevant mark of 100 per US dollar. And that was a key trigger for the CBR to abandon its previous course of monetary easing, as the currency lost about 40% of its external value at the time. So to date, the CBR has raised the policy rate from 7.5% to 16% and has also tightened capital controls. But despite this decisive monetary policy response, the ruble has remained weak and volatile, and there are several reasons for that. Most importantly, the declining energy export earnings under Western sanctions has broken the currency's positive correlation with crude oil price gains. And at the same time, strong domestic demand and a speedy rerouting of supply lines away from the West have all contributed to an import rebound, which has increased the demand for Chinese yuan, which is the preferred currency for cross border payments. Lastly, the fiscal rules around oil and gas windfalls have actually limited the CBR's ability to support the ruble by intervening in the FX market. And so this backdrop of weak ruble and persistent pro-inflationary factors has led the CBR to signal tighter for longer monetary policy over the next 2 years. We do expect a few cuts, mostly in 2025, as we expect government spending to peak this year. But with our projections of above target inflation both this year and next year, we will remain restrictive, and we see them ending 2025 still in double digits.
Thanks for that, Shu. And Harumi, let's go to Japan, which also is a different narrative from the US and the ECB, as we've been discussing. What is it that prompted Japan to start raising rates, and what is the BOJ trying to achieve there?
Okay. The wage growth was the key driver for the BOJ's decisions. We saw the early result of the annual wage negotiation in March, which was in average 5.2528%, and it was the biggest rise since 1991. This made the BOJ to consider the probability to achieve 2% inflation target has risen. The BOJ is trying to achieve the sustainable inflation of 2% through the vicious cycle between wages and prices. In other words, the bank is waiting for the sustainable inflation driven by the consumer demand supported by sufficient wage increase. The BOJ will move once it becomes more confident about the inflation outlook, which is to say, if wages actually increase and outpace inflation while strengthening private consumption.
Thanks, Harumi. Following the April 26th policy meeting, the yen significantly weakened, as we've discussed.
Mhm.
How might that influence the course of the BOJ's monetary policy decisions? What might the BOJ do to shore up the yen?
The weakness of the yen reflects the wider interest rate differentials. This is due partially to the outlook the BOJ maintain the accommodative policy, but also, more importantly, to the factoring in slower than expected anticipated policy rate cut by U.S. Federal Reserve. But the BOJ is unlikely to raise its policy rate in response to the yen depreciation. But we think it could move up its schedule for the rate hike if higher import prices lifted consumer prices more than expected and then affect the wage increase.
And one more question for you, Harumi. When will the BOJ start tapering asset purchases?
Okay, the BOJ has decided to stop yield curve control and purchasing the risk asset, but still continue to purchasing the government bond. The BOJ could begin to reduce purchase of the Japanese government bonds slightly in response to the market conditions, but it is unlikely to start meaningful reduction until the policy rate could come close to the neutral rate, which probably in the later 2026. Or unless the bond market participant increase enough so that the Bank of Japan do not need to fight with the speculative surges. But the Bank of Japan do not plan to use the tapering as an active instrument to raise bond yields, as the short-term interest rate is now the main policy instrument.
Okay, thank you for that.
So, we've given you all a lot to think about today, and we are committed to continuing the conversation. Please look for our analysis and thematic coverage on our blog. And that is all the time we have for today. Thanks to Rumi and Shu, and thanks to you for engaging with us today.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and don't forget to subscribe to the podcast so you never miss an episode.